So far, we talked about the growth rate, and going back to our discussion before, the reason that we talked about the growth rate is because we want to know what determines the external funds required, or EFN. So in chapter 1 and 2, we analyze a firm's performance based on the financial statements. And in chapter 3 and 4, we talked about its future by completing its pro forma financial statements and to calculate its external funding needed. And then the next question is about, now we decide that now we know how much money we need, and then we need to decide where we can find the money. So we need to decide the instrument that we are going to rely on for the financing. So in this chapter, in chapter 6, we are going to decide whether we should raise the money in debt or whether we should raise the money in equity. And because this financing decision chapter is a very complicated one, so I'm going to start with the classical theory to talk about the major factors or the issues in this decision-making process, and then I'm going to expand the factors into from 2 to 5 and so on. So we are going to start with the classical theory in financing. So as we have learned, the financing decision can have 2 steps. First, you need to decide how much money you need. And we learned the way of doing this in chapter 3 by calculating the external funding needed. And the next step is obviously to choose the proper financing instrument. How can we raise the money? And in reality, there are a lot of ways to raise the money. For example, starting from the bank loan, the debt financing such as convertible bond, and equity financing such as common stock. So you can have multiple choices, and it depends on your situations and the financier's situations. So the banks and security firms and your financial institutions you are going to negotiate with them to get a better options for your choices. But simply put, we need to decide whether we should raise equity or we should raise debt. So that is our decision in this chapter that we can learn from this chapter. And to decide that matter, we often use the term capital structure. So by the capital structure, I mean the combination of debt and equity in a firm. So it is like, for example, a firm can have a capital structure of 40% of debt and 60% of equity, or another firm can have 80% of debt and 20% of equity. So these are the capital structures. And about the capital structure, the most famous and the classical theory is proposed by 2 renowned economists, Modigliani and Miller. So taking their first name, we often call this theory as MM theory. So these 2 economists are so influential, although they have already passed away. So both of them received the Nobel Prize in Economics in 1985 and 1990. And together, they have written and published 2 research articles called The Cost of Capital, Corporation Finance, and the Theory of Investment in 1958, and Corporate Income Taxes and the Cost of Capital, a Correction in 1963. So you can think of these 2 as an initial version of their theory and the revised version. So this is version 1.0, and this is version 2.0. Okay, and as you can see, they firstly published this one in 1988 with by imagine a theoretical world, and they conclude that they get one conclusion. But there was a lot of discussion whether it is true or not in reality, and after several years they have adapted the criticism and they modified their theory and proposed the second version of their research article, which is why we can find the A correction in the title of this article. So today I'm going to talk about the 1988 version first, and then going to talk about the 63 version. So the initial version. It can be summarized as this one, irrelevance. So irrelevance means that it does not matter. It does not matter whether a firm raised that financing or not. So a firm can have no debt at all, and the other firm can have 80 or 90% of that, but actually both of them are the same. So here, this equation summarizes their finding. So here, VL, so it is levered firm's value, and this is unlevered firm's value. So levered firm's value is the same as unlevered firm's value. So you don't have to pay a lot of attention to the capital structure problem. So it does not matter, and you don't have to worry about it, and whatever you choose, you are doing the right thing. So this is the conclusion of them. And it seems contrary to our common belief or common knowledge. So I'm going to introduce this example to describe why it can happen in reality. And by the way, one of the major assumptions which is required to get this conclusion is that there is no taxes. So there is no government in this theory, and then we can find that this actually holds for the imaginary firms. So I'm going to think about an imaginary firm, Bold Corporation. So this firm is so bold, so they are raising its capital, and about 80% of the money is from the other's money. So its long-term debt has value of $80 million, while the market value of its assets is $100 million. And the interest rate is 10%. And with this money, they were able to have net income of $32 million, and they have shares outstanding of 4 million shares. And for simplicity, I'm going to assume that they pay all the net income to the shareholders, so their dividend ratio is 100%. And there's a new person, newly hired CEO, Chief Executive Officer, Ms. Safety, and she believes that this is too risky because 80% is from others' money, so she wants to improve its capital structure, and she suggests that this company has to pay all the debt back. So for this, the company will issue new common stock worth of $80 million, and then use the proceed to pay the existing long-term debt. So it is trying to convert from a levered firm to unlevered firm. And we can calculate several information from this given information. So first, this is the market value of asset, and this is the value of debt. So therefore, the difference between them will be the market value of equity. And by dividing with the number of shares outstanding, we can calculate the share price for each share. And it is $5 per share. And now in the stock market, the firm's stock is sold at $5 per share. So to raise $80 million, it needs to issue 16 billion shares. It needs to create additional 16 million shares and to sell them to the public investors. And then because the existing shares are 4 million shares, and now we add 60 million shares, after that change, the total number of shares will be 20 million. And let's see what happens to their income statement. Before the change, its net income was $32 million. And the market value of equity was $20 million. So I'm going to assume that the book value is the same as well. And by dividing net income with the equity, we can calculate the ROE, and it is 160%. Really, really good company. And earnings per share is calculated as the net income divided by the number of shares. So because before the change, it had 4 million shares, by dividing 32 with 4, we can get $8 per share as the earnings per share. And also, because its dividend ratio is 100%, this $8 per share will be given to each shareholder, because all the net income will be distributed to the shareholders. So each of the shareholder will get $8 after this year. And however, now we are making change in our capital structure. So to calculate this, we need to go back to the top side of our income statement. So we are going to calculate the EBIT. So because we are assuming that there is no tax here, but this company has $80 million of existing debt, and with the interest rate of 10%, so annually it needs to pay $8 million to the debt holders. Therefore, the interest expenses will be $8 million, and by calculating it back, we can get the EBIT. So EBIT minus interest expense will be the net income, which was 32 million. So EBIT should be $40 million. And because there is no change in the operation, the only change is made in the capital structure. So the EBIT will be the same after this change. So we are going to accept the EBIT will be the same before and after. So EBIT will be $40 million. And now the company had paid all the debt back to the debt holders. So there is no existing debt. So we don't have to pay interest expenses anymore. So interest expenses will be zero after the change. And furthermore, we don't have to pay the taxes because we assume that there is no tax. Therefore, the EBIT $40 million will be the net income. And the change is made from the equity side because before the change, equity was worth of $20 million. However, it has raised additional $80 million of equity. So 20 plus 80 will be 100 million. So equity will be $100 million. So by dividing net income with the equity, ROE will become 40%, and earnings per share will be $40 million divided by the total number of shares, which is 20 million. Therefore, earnings per share will be $2 per share. So as you can see, now it seems that actually by reducing the debt, we are experiencing a reduction in those ratios. ROE has fallen, EPS has also fallen. So it seems that shareholders are taking the cost of this change. And it actually meets our expectation because we know that ROE depends on the equity multiplier. So because now equity multiplier becomes lower, so ROE should be lowered. So that's what we can find from this. However, Modigliani and Miller further suggest that this is not true. So let's go further and think about a shareholder. So maybe there could be a shareholder who is angry about this decision. So I'm going to call him as Mr. Angry. And he is holding one share of the bold corporation. And then he was not satisfied because his dividend income was $8 per share before the change, but now it is reduced to $2 per share. So there's a reduction. So he is unhappy about this decision. So what he is going to do? In response to the change, he will borrow $20 from a bank at the same interest rate, 10%. And then he will use the money to purchase additional shares of the company. So because the stock price was $5 and he has now more $20, he can purchase 4 shares. So he had 1 share before and now he have 4 shares additionally. So now he has 5 shares in total. And then let's see his income log. So before the change, he had 1 share only. However, for each share, the dividend was $8. So he was able to get $8 as a dividend income. And there, he didn't rely on the bank money, but it was his own money. So there was no interest expense. So $8 can be his profit. And he invested $5 because the stock price was $5. So the actual investment he made is $5. So actually he made $8 out of $5. So investment return should be 160%. However, after the change, now he borrowed the money and purchased additional shares. So now he has 5 shares in total. But for each share, the dividend is reduced to $2. So he gets 5 times 2 equals $10 as the dividend income. And remember that he borrowed $20 from the bank at interest rate of 10%. So he needs to pay $2 to the bank. So by deducting $2, he can get $8, which is exactly the same as the net profit before the change. So his money, the money out of his pocket was $5, and the other was coming from the bank. His actual investment is still $5. So his investment return is still 160%. So actually, regardless of this capital structure changes, he can maintain his profit. So therefore, from shareholders' point of view, the value of the firm does not change whenever its capital structure changes. So the critical assumption here is that there is no tax. So when there is no tax, this is an imaginary world. And in this imaginary situation, theoretical situation, it does not matter whether a firm chooses to have 80% of debt ratio or 20% of debt ratio or 0% of the debt ratio. So this can be represented as the this finding can be represented as this graph. Here, this is the debt ratio, debt to asset. And here is the value of a firm from a shareholder's point of view. And let's say the value of the firm was here when the debt to asset was 0, so when there is no leverage at all. And it will be the same with 20% of debt ratio, 40% of debt ratio, 60% of debt ratio, and 80% of the debt ratio. So it will be the same for all cases. So there is no change. So, and that's why we often call this finding as an irrelevance proposition. So after the release of their research article, a lot of practitioners and the researchers have argued that whether it can be true in reality or not, and they criticize that it must not be true in reality. And maybe firms want to have more performers to have a specific target debt ratio. And accepting those criticism, they released the second version, which is the 1963 version. And in this second version of their paper, they find that if we allow corporate taxes, then it matters for a firm to choose an adequate capital structure, and actually the firm value will become higher when the leverage ratio become higher. So here, this is the unlevered firm's value, and this is the levered firm's value. And as you can see, there is an addition to the value here. So the levered firm's value will be always higher than the unlevered firm due to this factor. And this factor is determined by the tax rate and the value of debt. So when there are more debt, the value increases further. So therefore, it is always better to increase the debt ratio. So that is their findings in their second version. So this can be represented in this graph like this. So this is the unlevered firm's value, and it will become higher as the debt ratio increases, as there are more debt. So actually, in this version of theory, it is always better to have higher debt ratio. And then their target should be 99.99999%. So the best ideal option is to have only $1 of equity and the rest of assets filled with debt. However, we can have 100% of debt to asset because we always need to have at least $1 of equity. So anyway, it is always better to use or rely on the debt financing. Okay, so let me use the example before. So now we are going to assume that the both corporation has to pay corporate taxes of 40%, and then the EBIT was the same as $40 million, and the interest expenses are the same, $8 million. However, now we have to consider the tax expenses. So taxable income is 32, and 40% will be $12,800,000. So the net income will be $19.2 million. Therefore, ROE and EPS are calculated as following, 96% and $4.8. But in this situation, now thanks to the capital structure change, there is no interest expenses, and the EBIT will be $40 million. So this is the same as the first version, but now the difference is that they have to pay the tax, which is $16 million. But you can see that the amount of tax is lower in the before case because it only have to pay $12,800,000 before, but after the change, it has to pay $16 million. And the reason is because before the calculation of the tax, we are going to consider interest expenses as a cost. So by reducing its taxable income, it provides a shield for the company for tax. So the tax amount should be reduced as much as the interest expenses. Of course, because now they don't have to pay the interest expense, so the net income will be lower when they have interest expenses. However, we have to pay attention to this lowered level of taxes. And the earnings per share will be 1.2 after the change. And remember this number. And Mr. Angry will do the same thing again. So he will go to a bank to borrow $20 and to purchase additional 4 shares. But now things does not work as he desired. So before the change, he had only 1 share and the EPS was $4.8. So he received dividends of $4.8 and his investment return is 96%. However, now he has 5 shares and for each share he received $1.2 as a dividend. So his total dividend income will be $6, but he has to pay back $2 of interest, and now he has $4 as the profit. So therefore, the profit is reduced and investment return is reduced. So therefore, we can conclude that it is not possible to maintain the same level of investment return when the firm changes its capital structure and when there are corporate taxes, and as the debt ratio decreases, the shareholders' profit decrease. So in other words, from the shareholders' point of view, the value of the firm will be higher when its leverage ratio is higher. And the main reason was the reduction in taxes, as I mentioned. So tax expenses was lower when the firm had leverage, and the effect, the interest tax shield can be calculated as this. So the difference between these two. So there was a reduction in tax expenses thanks to the interest, which will be obtained the same by calculating the principal amount of debt multiplied by the interest rate multiplied by the tax rate.